It's always interesting to see how investors react to different market events. With 23 years of managing money for clients and advisors throughout this country, we have a unique perspective. As we have experienced in the past, once again, we're seeing investors hypersensitive to performance numbers. My name is Jeff Hybiak, and I'm the Portfolio Manager for Strategic Equity Management. Today we want to address one of the key questions clients have been asking. Are SEM's programs still working? 2015 has definitely been an interesting ride. This chart here shows the year-to-date performance of the two edges of our investment program, EGA, which is enhanced growth, the more aggressive portion, and then income allocator, which is our more conservative investment. And then the dashed lines show the benchmark that a lot of clients use to evaluate them, which is the S&P 500 for EGA, sometimes our income programs as well, and then the aggregate bond index, which is dashed in teal. Now, there have been a few distinct periods that we've witnessed so far this year. The first phase was what, I just call a decent year. Everybody was looking at it and saying, hey, things aren't too bad. Following the big moves in 2013 and 2014, many people were actually expecting a lot of volatility when QE3 ended, and that didn't happen. And so it was, people expecting a sell-off didn't happen. They said, this isn't too bad. And our programs were outperforming their respective benchmarks, as well as S&P 500 and aggregate bond index, quite decently, using that phrase again, during that portion of the year. But despite our outperformance of these benchmarks, we still started hearing a lot of clients saying, I need higher returns, and that really picked up in the summer. But then over the summer, the volatility everyone was concerned about after the end of QE3 finally kicked in, and then we saw rapid declines in the stock market as well as in high yield and emerging market bonds, which are two of the key components to returns of income allocator and tactical bond. As has been the case in almost every large sellout, our systems didn't get out at the top. They're not designed to do that, and we'll talk about that in a little bit. Throughout September, we heard from a steady stream of clients and advisors complimenting and thanking us for once again preventing clients from fully participating in the market losses. We also heard clients that had told us a few months earlier that they wanted to get more aggressive with their portfolios, ask if it was too late to go back, or we had those who hadn't made that move yet, very thankful that they didn't. And then a funny thing happened. The market came close to retesting its lows at the end of September and suddenly took off to the races. None of the catalysts that caused the sell-off had been resolved, yet somebody started speculating that bad economic data could mean good news for stocks. It's the same thing we've seen over and over again. Our systems, which are designed to pick up large money flows from the institutions, did not see any sign the market had reached a bottom, and they remained defensively invested throughout a lot of October. It didn't mean we didn't have gains, we just didn't have the spectacular gains that the S&P 500 had. The further the market has climbed, the more convinced investors are that the worst is behind them, something we've seen over and over again with some of these rallies. After praising the defensive maneuvers that we took in September, a lot of the same people are now calling into question the viability of these systems. We would like to say that this is a new occurrence, but unfortunately it's quite common in the later stages of a bull market. Investors tend to make irrational decisions based on short-term data, like the last 4 to 5 weeks, and that's almost always a sign of the end of a bull run. They're on edge, they know the market's due, but then they want to get the returns, and you just see this back and forth movement. Based on market history and what the data is telling us currently, our systems are saying there still is a good likelihood that we could be in one of those phases where we get a final blow off top, and we'll talk about that in just a minute. But to really understand what's going on with our systems, let's take a look at Enhanced Growth Allocator and some of its components. EGA is a core and satellite system, meaning there are two distinct portions of the portfolio that come into play, and we've illustrated it there in the chart. The core is the piece that is designed to stay invested in the higher performing sectors throughout the bull market. With that goal in mind, this means the core will allow the market to drop around 7 to 10% without even flinching. This is because the market normally will lose 10% once per year. Now, we went a while without having one. We had our first 10% loss since 2011. So that means we didn't have one in 12, 13, or 14. So it was way overdue to have that kind of a loss. But unfortunately for us, The market went from being down 7% to down 12% in a couple of days, leaving our core little opportunity to move to a defensive position. That happens sometimes, and it's just kind of the nature of the game. Now, it did get defensive when the market rallied back up, and that allowed us to actually make money in September while the market still lost money. But unfortunately, it wasn't quite ready. We have seen it start to nibble a little bit here in November, but it's looking for institutional money flow, signs that we're in for an intermediate term rally, not just a snapback rally. And we'll talk about some of those differences here in just a minute. Turning our attention to the satellite, this is the portion of EGA that is much smaller than the core, and it's designed to tweak our asset allocation to increase exposure during a bull market like we saw over the last couple of years, or to pull it back down when necessary. Now, during August, the satellite was not quite fully invested, but it was pretty close. Again, everything was looking pretty good as far as the short to intermediate term picture. It got a little bit more defensive on the downside, but it actually started adding back exposure on the retest in late September. And then throughout October, it saw increasing signals coming in. And so it is now fully invested. And so a lot of our returns in October, again, we made money. It just wasn't as much as the S&P 500. So the returns we saw was fully because of the satellite system. Had we not had the satellite, we would have been sitting in cash and bonds and really had people calling into question. Now again, this is by design. We want to be able to navigate different types of the market with the overall goal of having good risk-adjusted returns based on the asset classes we're investing in. Which brings us to another point. One more thing on EGA and the S&P 500. That's not our benchmark. That's 500 U.S. stock companies, not the full universe of stocks that we can invest in. So our benchmark is what we call the aggressive allocation index, which includes international stocks, small cap, mid cap, growth and value. It just basically, what's the universe of growth type investments that we can invest in? They have not done even close to as well as those 500 stocks. And that's one thing our systems are looking at, is maybe it's just speculators that have been jumping into the market and not large institutions. That's something that we typically see happening when we're either in the late stages of a bull market or the early stages of a bear market. Now what's really critical to understand with EGA is almost exclusively we follow a trend following system. Now we have some systems like our volatility system, some components of our price divergence that aren't fully trend following, but by and large that's what we're doing. And that's because we've looked at all the different indicators out there, and the best one if you're trying to avoid large losses is a trend following system. That means you're going to not get out until the market has peaked a little bit, and you're not going to get back in until it's rallied a bit. Now when the little bit, a couple of days goes up or down 5 to 7%, like we saw in August, September, and October, trend following is going to look like it's unfavorable. But over the long run, we found that that's the best way to both capture a good portion of the upside as well as to miss a good portion of the downside. Because the problem if you try to use other things like an oversold or a contrarian system where you're only buying when the market's down a lot, is the market can be going down, from down a lot to down a whole lot to even a whole lot more. And that's what we see happening during bear markets. So our EGA system is designed to try to look at the big picture market history. And the question, do our programs not work anymore? These core of our systems, both the core component and the satellite, they've been around for a couple of decades now. And that's not changing, but we are still looking at ways of making more money. I've spent an exhausting week working on a different type of volatility system where we can invest in more sectors that have fallen out of favor but have strong relative strength. Not to bore you with the details, but there's a lot of promise there. That could be a tweak to enhance growth, or a tweak to our absolute return, or something else. We've looked at different ways to make money in income allocator over the last few weeks, but they're just tweaks. The core ideas have not changed, and that's really important to understand. Market history tells us that we might have different ways the market goes up and different drivers behind when it goes down, but market history doesn't change because the driver of that is human emotions. And for us, the best way to measure that is trend following, which is still going to be the core of our systems. And I don't see that going away the last 5 to 6 weeks notwithstanding. Now, let's take a look at the overall big picture, because this helps explain a little bit of what could be going on in the market. Now, I included this chart in our most recent newsletter because it's a critical concept for all investors to understand. It highlights perfectly the difference between short-term and long-term outlooks. Now, we know with hindsight when the market peaked, but in the thick of the battle, there were many rallies that sucked investors into believing that, hey, the worst is over, now is the time to get in. Let's take a look at those three call-outs that I had in the chart there. Now, looking at 99 and 2000, after starting the year with nearly a 10% loss, the year 2000 then brought a final 15% rally that marked the top, that blow-off top that is very typical of not just a recent end of a bull market, but almost throughout history you see some sort of a big blow-off top. But that didn't prevent some strong rallies from happening. We saw 5 more 5% or higher rallies occurring just in the year 2000. We saw more in 2001 and 2002. So that is typical in a bear market where you see these big rallies, and every time it was so frustrating to hear people say, look, the worst is over. You turn on CNBC or Bloomberg or whatever you're reading on the internet, and people say, well, look, the worst is over. Look what the market just did. Never let the current market direction dictate your overall investment picture. We're going to talk about an objective way here at the end, so stay tuned on how we can tweak your portfolio a little bit, based on some objective data, not just your emotions. But not to get too far ahead of ourselves, let's look now at 2007-2008 peak. Again, saw a furious rally, went down 10%, then rallied 11%. Hindsight, we know that was the top. Then we saw several more big rallies again, just in throughout 2008. We know the worst wasn't over until 2009, but again, we saw investors saying, look, the worst is over. We saw people on TV and on the internet, again, the worst is over. And again, it wasn't over till it was over. So using current market direction to dictate your feelings is not a winning strategy. But what does that mean for the current market environment? Now, we don't have the benefit of hindsight yet. We don't know what the future may hold, but we could again be seeing history repeating itself with that one last final blow-off rally. Again, we had a big drop of more than 10%, just like we saw in 2000 and again in 2007. And then we've had a 10% plus rally, 11, 12% right now. And that may be that final last blow-off based on some of the things we're seeing. The fundamental data, the participation of institutions, just the length of the economic expansion and things like that tells us we could be in that time where with hindsight we're going to look back and say, oh yeah, it peaked in July, or oh yeah, it peaked in November, or whenever that was. But we're not going to have the benefit of hindsight. So it becomes very important to not just look at market direction and look at your overall financial picture. Before we get to that, though, let's look at the other programs and the bond market. Now, looking at the bond market, and specifically income allocator and tactical bond, we see that they're still suffering from the same thing most fixed income investments are suffering from, which is it's tough to make money when rates are this low. In addition, the spread between risky bonds and not risky bonds and short-term and long-term has become very difficult to eke out any sort of return that's consistent. Now, you could see here on this chart, we saw a little bit of a turn up with the change in that panic that we saw in August and September. So we are seeing potentially higher returns inside of the bond market. Now, we've studied the drivers of income allocator performance and really conclude there's two primary factors in their future performance. The difference between long-term and short-term treasury bonds, and the difference in yield between high-yield bonds and treasury bonds. Those are both a quality spread and a maturity spread. But by far the biggest contributor is that spread, the quality spread between high yield and treasuries. Let's take a closer look at that. The recent increases in high yield bond yields has created the best opportunity since 2012 to make money in income allocator as well as tactical bond. If nothing changes in the year ahead, we could be looking at a point where we could again get back to those mid-single digit performance. Nothing to get real excited about, but a lot better than we've seen recently. Now, it certainly beats locking in rates in a money market or some of these fixed annuities that we've seen at the rates now. We're going to try to do the best we can. And based on that, there's the potential there. However, bigger picture, this program is highly economic economically sensitive, easy for me to say, the longer an economic expansion continues, the harder it gets to make money. The history of income allocator and tactical bond bears this out. It struggles near the end of that economic expansion. But during the recession, those opportunities escalate because the spread goes way up there. Now, that's the mountain there that you see. And then you see the subsequent 12-year or 12-month returns after that. So the peak in income allocator comes when those spreads explode. Now, I'd hate to see people getting out of income allocator and tactical bond, moving to something, and then not coming back until after we've got in and made some of those returns. You're not going to know until you have the benefit of hindsight when that occurred. So we're going to try to just keep squeezing out what returns we can, and then just bide our time waiting for a much bigger opportunity that we know is coming. Things haven't changed. Market history hasn't changed. Spreads are going to move back higher. That's what history tells us. What's really important is the economy. Now, economic growth really comes down to this graph that I showed in our most recent newsletter. It's still looking decent, around 2.4 to 2.7% over the next year. Not bad, not about, back to the long-term average, although recent reports have put us down into the lower bracket of that, around 2.4%. Really what I'm concerned about is that negative feedback loop that we illustrated there on that chart. It can't be solved with more easing. It's not going to be solved by keeping interest rates low. There's really no way out of it because it's a consequence of what we've seen over the last 6 years trying to fight the last recession. We still have some of those things in place, and the more other central banks try to copy what the US did, the more pressure it puts on us. And then the pressure there puts pressure back on them. And it's really a negative feedback loop, trying to wipe out the excesses and get back to a more stable ground. But one thing becomes quite clear of that. We don't know how this is going to turn out. But stock prices can get hurt. Riskier bond prices can get hurt. Everything can get hurt, minus the safety of money market. And again, this is where strategic equity comes in. Our bread and butter is protecting assets during the downside. We're going to miss rallies. All those rallies that we illustrated in 2000 and 2008, we're going to miss them because a trend change happened. Something happened that said, okay, we're in a different environment now. That's the beauty of our systems, is they are designed to adapt. Just the sheer length of the economic expansion tells us we're due for that recession. On average, the market loses 35 to 40%. It's not going to happen all in a couple of days like we saw in August and September. That was kind of the warning shot. Our systems have taken notice. We are watching the market on a daily basis, trying to give the best possible returns with the amount of risk that our portfolios dictate. So let's look at what really matters when it comes to deciding what to do with your investments. Our industry has done a really poor job of addressing proper portfolio construction. Too many times investors are told to target specific returns, and then they're left trying to justify the risk that they're taking. One of the fundamental laws of investing is the higher returns you seek, the more risk you must take. The problem is when investors are told to assess their risk, too many times the focus is on the willingness to take risk and not what their ability to take risk is. Now, I'm going to try to put together another video that addresses that specifically. I know we're going a little long now, but study this chart because we want to look at not so much your willingness to take risk. We'll definitely adjust to that and try to figure out ways around it. But we want to look at the ability, and that's all data. That's not emotional. And you can see on that chart some of the things that you can look at. Now, with taking that into account, investors in our programs have a few choices that they can make. With income allocator and tactical bond, they can move to a safe or a guaranteed investment like a CD or some sort of annuity type product. Of course, the risk there is you're locking yourself into those low returns, and you might need higher returns because of some of those things we listed there on the table. Or you could remain an income allocator and tactical bond, wait for the low-hanging fruit to appear on the other side of the recession, which is when you just love these programs. Now, a lot of people love them when the market's been going down 20 or 30% and they're close to the flat line, if we've seen. But they really love it when we can get that low-hanging fruit. Or you can move to a higher returning investment. That starts to turn into return chasing and flipping the risk tolerance equation around, where you're seeking return and justifying the risk, and that's always a losing proposition. Obviously, I would recommend the second thing. Remain in income allocating tactical bonds so long as your ability to take risk matches up to that. Other bigger returns are coming on the other side. Patience is the key. Going back to our history, we saw it at the end of the bubble in 99 and 2000. The last few years, we had returns less than money markets. Same thing happened in 2005, 6, and 7 with income allocator and tactical bond. We were making less than you would have in a money market, but you got to take a little bit of risk in order to try to make some money. And we'll do that where we can, but we also won't take a lot of risk just because we need higher returns. And that becomes important with those programs. Now, looking at enhanced growth, you have 3 options as well. Move to an investment that has more exposure to a market. There's plenty of mutual funds that did great in October. They were talking about them on CNBC and then Bloomberg. You go to USA Today and Morningstar has a list of them. There's 10, 12, 15% returning mutual funds from October. However, that may look good right now, but then you've got to look at your ability to tolerate the downside there. Don't just go to an investment because it had a great October. Look at the big picture. The other option, remain in enhanced growth and wait patiently for better opportunities. They're coming. And you look at the track record there and how it's done versus, say, an aggressive allocation index, and it's done rather well of giving you that exposure, but not so much of the downside. Or we've heard people say, I didn't realize enhanced growth could lose that much, and move to a lower risk investment. That's fine if your risk tolerance, that ability to take risk, has changed. But overall, you don't want to use the last 12 to 18 months even to make your decisions on your portfolio, because this is we're in that sea change right now. That's what the volatility is telling us. That's what a lot of the fundamental data is telling us. That's what the technical data is telling us. Is we're going through that change. We're about to enter a different environment. Our systems have all gone through that change. They always struggle at this time. Then again, they'll be back to where they were at in September, where they look like heroes on the downside. And then the difference is, once we've washed out a lot of the excesses, then we're to that place where it's easy to make money with active investing. Right now, it's difficult to make money, which is why we don't make as many investments. We're going to have investments go wrong, but that's all part of this game where we're trying to lower the risk in the portfolios, knowing the market history, knowing what the fundamentals and technical data tells us. So, I would recommend patience. Give our office a call, talk to your advisor, if you're an individual client, and just say, what is my ability to take risk? Where could I tweak my portfolio rather than making wholesale changes? That becomes important now. Again, we'll deal more with risk tolerance in a future video update. We've covered a lot of information today. I'll give much more information if any of you have been to my website. You can go to semtradersblog.com as a shortcut to get to that. Go right to the Traders blog. You can register for the site, whether you're an individual investor or a professional investor. Just check it out. We also will, next economic update will be posted there. Our weekly podcast will be posted there. We'll have a lot of details to fill in there. I didn't want to go this long, but it's really important for you to understand what's going on in the market, what's going on with our portfolios, and just know that we're here every day. I've been working 11, 12-hour days because not only are we managing the money currently, but we're looking at ways where we could make, the next time we go through this sea change in the market, maybe there are ways we could buy in sooner. Maybe there are ways we can get out sooner. We don't know until we test those ideas, and every time this happens, something comes up. There's a reason we've been at this for 23 years, and that's because our systems can adapt, they can evolve, but the core philosophy of unemotionally investing money, focusing on risk-adjusted returns, getting the best returns possible for the level of risk you're taking, that has not changed. That's not going away, and we're going to continue to find ways to do it even better. I thank you for your time, and we look forward to seeing you again in future updates.